Tony, I mean, Kevin, we won't, we'll give everyone a minute to get loaded so we can keep on with the chatter. So is this a great niece or nephew?
Yes, it is a
Okay.
great, it is my first great, it's my third great niece or nephew because I've got a niece who's got a couple of kids on my wife's side, but on my side of the family, it's the first one. Yeah.
Yeah. That's
Yeah,
awesome.
she's
So,
21. So she's a 21-year-old mom, which is probably not ideal, but the kid's cute.
hey, it is. At least you're there to support her. Speaking of babies, today is Ryan Carr's first day back
Oh,
from
wow.
maternity leave. So we got the opportunity to see Elisha on a internal call this morning, which was awesome. So everyone, we're just waiting for people to get loaded into the session before we kick off with the SIP. So we'll give it another few seconds. We realize that we're live. We're just filling up the time. And I have a disclaimer. So I usually have like a can of water or an empty glass in front of me. I ran into the kitchen and poured my LaCroix into a wine tumbler. So full disclaimer, and you all know I'm fully transparent. I am not drinking wine yet today, or bourbon, or anything else.
We have some doubters in the comments.
Yeah, as always. So, all right, everyone, let's get started. I don't need to do a huge intro. I really do hope by now everyone realizes what the SIP is, but just as a brief intro for those who may be joining for the first time, the SIP is a place where we bring the mortgage collaboratives, preferred partners, and lender members together to demonstrate real world case studies and how we are collaboratively moving the industry forward. And today's session is proudly sponsored by Blend, a leader in our point of sale technology, helping lenders streamline workflows and elevate the borrower experience. And joining us is Justin Van Housen, General Manager of Blend, and special guest, Kevin Williams, President of Compass Mortgage, who is joining us while he's visiting a great niece or nephew who was just born. I didn't catch which. Faith, somehow you're on video. Thank you. These two bring a deep expertise from both the tech and the lending side of business, and we're excited to hear what's on top of mind for them. So grab your cup of coffee or your tumbler of LaCroix and settle in, and let's get started. We're going to switch things up a little bit today as we look at industry news and evolving priorities of our lender members as we head into the new year. But first, let's get some intros in. Justin, you're about a year into your role
Yep.
as general manager at Blend, and you've got a strong background on the lending side. Can you share a bit about Blend, your role, and what the transition has been like for you over the last year entering the technology world?
Yeah, appreciate that. Yeah, Justin Venhausen, I'm the general manager at Blend, focused on independent banks, independent mortgage banks and builders. Been doing it about a year, so it's been a fun year. We are a lot of the transition for me. It's been a fun transition. I've always had a little bit of a tech bent. Operations and tech have kind of always been the two things I've always leaned on, and I'm definitely able to utilize those skill sets here. I think in particular, what's been fun and exciting is just like, I don't know if there's ever been such great technological shift as this past year has brought, which is the introductions of it. Like, it's a year where everybody rethought everything, right? I mean, like, what's a better way to do X, fill in the blank. So being able to sit in that and having a tool that, like, honestly, has been built and positioned very, very well to be able to play this role for lenders has been a lot of fun. So we've had a lot of success with our IMBs, and it's been a great year and looking forward to next year.
Awesome. And Kevin, many of the TMC community know you well, but for those that are tuning in for the first time, tell us about Compass Mortgage and your role there.
Yeah, Compass Mortgage has been around since 1999, so this is we just finished our 26th year in October. And we're a mortgage banker, focusing largely in the greater Chicago area, but we lend in almost 50 states now. I've been at Compass for 23 years. I started here after a career in technology implementation. I was a developer and a project manager for a third-party integration firm. And I didn't want to travel anymore once I started having kids. And I had a buddy who started a mortgage company, and we were both deacons for our church, and I balanced the checkbook for the church. He thought that qualified me to be his chief financial officer, and here we are. Now I'm president of the company. So, who says the mortgage industry doesn't provide opportunity, huh? So,
Absolutely.
but yeah, I've loved it. It's been a great roller coaster ride. But I love the mortgage industry, and I'm glad to be here.
Yeah, so 23 years and 4 months, I think, to be exact with Compass. That's some serious staying power and almost for the life of the company. So kudos to you, and they must really like you.
Well, people get used to you.
Um, It was great to get reacquainted with both of you. But I want to shift gears and dig into the heart of the conversation, which today we would like to talk about some industry news that we've heard over the last couple of weeks. So let's start with, where did you first hear? I feel like we're playing a game. Like, is this like truth or dare? Um, or what is the other one? Something or lie? Anyway.
Two truths and a lie.
Let's start with, where did you first hear about the 50-year mortgage? I was going to ask you if it was on a tweet, a headline, or other viral social media posts that made you do a double take, but I heard that Twitter's down today, so we can't talk about anything that X is Twitter, right? So we can't get any national updates from leadership in DC. So we'll have to talk about stuff that didn't happen today since our Twitter feeds are down. So, Kevin, what do you think? We leapfrogged the 40-year right into the 50-year. I'd love to hear your take and your reaction on the idea.
Well, first of all, I love that they're thinking out of the box and trying to figure out ways to do different things. I'm not sure it's the best. And I think that I was gonna say, I'm not sure it's the best medium to get it out there, but I think the idea is just to get us all talking about it, and here we are. So maybe they're smarter than we think they are. I think it sounds good, but just like when Pulte tweeted, what was it, 6 months ago, that VantageScore 4.0 would be taken by Fannie and Freddie. There's a lot that needs to be done to figure this out, right? And a million different questions go through your mind, like how do you hedge that? And a million different other things. So, but I think it's good that they're bringing up these ideas and that we're beginning to think about them. The 50-year mortgage has been around, right, in other parts of the world. A couple of other countries distinctly. I think it's Japan and Norway, I believe. So there's some there's some history to this that I think we could potentially learn from. The thing that I'm the guy who always thinks of why something won't work. That's how my brain works, right? So I try to hide that because I like to be a solution provider, but I'm always thinking about what doesn't work. And the 40-year mortgage has been around for how long? 10 years, maybe? It's non-QM pricing. It's completely out of the ballpark. The pricing isn't anywhere where anyone would want to take advantage of it. And so now, though, we've got the guy who runs the two folks that set the price, Fannie and Freddie, for the most part, for the market. And I can't believe they're not going to price risk into this thing, because 50 years is a long time. So that's where I think I don't, it feels like it's going to be a novelty, but
Yeah.
I don't know.
Yeah. Justin,
Similar,
anything?
really similar. I mean, first and foremost, it's nice to have people trying to come up with solutions. I feel like often as an industry, it's really easy to talk about just what's not working without anything on the other end of like, well, we should do X. There's exceptions to that, but for the most part, if you're looking at LinkedIn, it's just the complaints and this why won't something work. It's an affordability play, clearly, is what they're trying to do, which I certainly appreciate. Like there is a lot of help that needs to happen there. Um, I think some of the more interesting stats I've seen on it is one Kevin alluded to. It's like often with this conversation, folks are missing the conversation on price, and that these are going to be just like a 30 is more expensive, has a bigger rate than a 15. A 50 is going to have one larger than a 30. Um, but also with the sorry, Kev, I'm hearing the echo again. Um, the affordability play, though, in and of itself, I think is interesting. And the other thing is most folks don't stay in their homes for the life of their mortgage, right? So that was another interesting point I saw on the other side, which was 7 or 8 years is typically the life of a loan that's actually executed before they move out and that loan ceases to exist. Um, so the question for me at the end, does it get more people in homes? It would be, that's the thing to measure. And if it can do that, I think anything that can do that should be considered. Whether or not it can, I'm certainly not the person to answer that, but I think I'm glad, to Kevin's point, I'm glad these things are being talked about and that folks are trying to get creative.
Yeah. All right. So here comes my rant warning. Here are my thoughts. So if you just look if rates were equal and given the median size home value today and mortgage, home buyers would save roughly $200 a month in savings. Likely that $200 is going to be eaten up by the rise in insurance and taxes anyway, and it's going to tack $400,000 worth of interest onto that loan. So, to your point, I hadn't thought about Justin from the aspect of people don't stay in their homes that long, but if we give access to more mortgages and putting more first-time home buyers into mortgages and affordability is the focus, what that's going to do by having more buyers is going to raise the price of homes. And if we raise the price, or it's going to put more competition there for people to buy homes, and we'll have rising price of homes, and we just further compound the issue that we already have with the pressures of supply driving up home prices. So that's my mini rant and my thoughts around it. I agree. Like I'm glad that people are trying to provide solutions and my theory is if you're coming with a problem without a solution, then you're just whining. So we are seeing some creativity there. So it'll be interesting to see if it gains legs or if anything happens with it. And we could make some wagers and predictions on that too. But Kevin, when we were doing so another creative idea, we were doing the prep session, you brought up portable mortgages during the call. It's such an interesting concept for those who may not know or be familiar with a portable mortgage. Would you break it down for them, what exactly a portable mortgage is, and what do you see as the pros and cons?
Yeah, I mean, at a high level, you have a mortgage. So those folks that are in their three handle right now, their 3 point something rate that aren't moving, at a high level, you can take your mortgage with you. And that's sort of what I think the tweet level of it is, right? Take your loan with you. Now the small print's got 72 pages, right?
Yeah.
So you have to requalify, right? Which you'd have to qualify for a new mortgage anyway. So, probably not that big of a deal. You'd be qualifying at a lower rate than the market if you're trying to take it with you. So that probably would help. if you had a prepayment penalty, it would help avoiding those, although most loans don't have prepayment penalties these days. So I don't know that that's that big of a deal. Uh, if you need more money, you're going to have to put another loan on there, right? Which is going to have to be a second lien behind the first one. So one of the interesting thoughts that I had is what happens to the home equity lenders? Now they're in third or fourth lien instead of second lien. I mean, does it really matter? Because if you're in second lien and it forecloses, you have to buy the loan to get in first lien anyway. So does it really matter? I don't know. But you're going to have a lot more loans floating around out there. And then you're stuck with your, in some ways, the general thought is that you're stuck with your lender, so you can't go to other rates. Now, if Fannie and Freddie do this, right, and you can port the Fannie and Freddie mortgage regardless of who originated it, then that might be interesting. I don't know what it means for us. Unless people are moving up, we're not going to, our industry is going to suffer a little bit from it. But I actually generally think it's a good idea. I have one thing though that I think, it's been done in other countries, and I think Japan's one of them. And if you're porting this mortgage and you're taking it with you, then I don't know that that is going to, except for in an environment that we're in right now. We're in this weird environment now that half the mortgages have less than a 4% rate, I think, right? And I've been doing this for 23 years. Some people have been doing it for a lot longer. That's not very common to have that kind of a spread in that short of a time frame. So in a normal market, I don't know how helpful it would be.
Yeah.
That's my thought.
Yeah, it definitely seems like a now problem to solve. So Justin, also known as Proud Girl Dad, any plans of moving in the near future? And whether you are or you're not, I love your take. How could portable mortgages impact the lending landscape and what that might mean to both lenders and to borrowers?
No plans to move. We're happy where we're at, and I think my kids would be upset, so we're not going to do that. Yeah, I mean, to me, where this is interesting is for folks going through life changes, though. Like the reality is anybody in that situation has a choice for the most part to just stay where they're at, and they're achieving the benefits of that loan they signed up for, right? So it's not really a benefit to that person unless they really need to move for a life circumstance. And for those people, I mean, this is obviously a no-brainer to give them that flexibility. For them, why wouldn't you want that, right? So that for that consumer, you would want that. I worry about all other consumers and the side effects that it has on that when you can just maintain that mortgage and bring it with you and what that does to them. I think the economics behind that would be kind of fascinating. But just with where I sat as a lender for a while, my head goes to just the management of how you would manage this as a mortgage lender. Now, Fannie and Freddie would have to drive this, but even then, my mind just goes sideways. There's so many questions, and like, how would that work without making it like a complete new loan, which is what the whole point kind of is you can retain some of those features. So maybe it's just you do a full underwrite, but then the end result you get your same rate. Certainly a fascinating idea, but I think to Kevin's point on the 75 pages of asterisks and fine points on how you get this done, that's where my head goes, is I just don't know how that's going to work.
Wow, you can tell that we're a session full of operators because we want to know the exact plan before anything is thrown out there. And wild tweets and wild ideas just do not fit. It gives us hives, and we want to try to figure out how that could actually work. My take on the thing is, yes, it preserves the interest rate. It does encourage mobility, which there could be two impacts to housing on this, right? Because I think of someone who is relocating for a job, or if they're moving, they're likely stepping up depending on where they are at in their home ownership journey. So I think that it could potentially open up more affordable housing if we see if the portable mortgage is largely going to higher priced homes, to allow their homes to be available for lower income. So I think that there could be some advantages, but I think that we still have the same issue. We have a lot of people that are staying put because of their interest rate that would otherwise, make a move. But then if everyone is taking advantage of it, like it really depends on the home value or the home price that they're looking at to say whether that would have a positive or a negative impact on housing affordability. I also think that, from a lender's perspective, I can guarantee you if Fannie or Freddie is going to be able, if this is going to work to their advantage, it's not going to work to lender's advantage because it is, moving that mortgage. There's already only so many ways that you can split margin in a traditional transaction, and there's very little margin to split to keep people's home the same price. And what would it cost? Like, what would I would think that it would raise the cost of origination, to put it into play by having to pay additional basis points potentially to loan officers, to re-underwriting the loan without having gain on sale. Like there's just a lot of things that I think that would really inflate the cost to originate or to port those mortgage loans. So again,
Maybe just not
it'll be
even for that
interesting.
loan. It could be for like that could get spread across all loans, right? Like you just increase the cost to originate because you need to make dollars somewhere. And now we just
Yeah,
worsened affordability, right? So
exactly.
those are the areas I get. The concept is why wouldn't you, right? Like sounds amazing. But
Yeah.
operationally, I feel like really hard to pull off.
Yeah. And then, a lot of people put extra dollars towards their mortgage to buy it down. So it also disincentivizes them to buy down the mortgage if they think that they can just move it to that rate to the next property. So I think there's a lot of consequences. And man, do I sound like a Debbie Downer today. No offense to the Debbies of the world, but try to make this more positive outcomes on the creativity that's happening in the industry today. But let's shift gears again. So, from the Pulse of the Network survey that we do with our lender members and countless working calls, it's clear to TMC members have spent much of 2025 ripping out unused tech and reinforcing their moves and how they move the needle. And they really are leaning towards workflow optimization, tools that really help them close loans faster and more efficiently. And it isn't about the new shiny object and putting it in place like it seemed like it was for many years. And to Justin's opening point, we really have seen some true movement in technology in 2025 and looking for more of that in 26. But Kevin, can you relate to this? What is your focus for the rest of the year and where are you headed in 2026?
Well, I mean, there's a lot going on, but for the last 2 years and going strong now this year and into next year, we're focused on just the speed of the transaction. And I think technology is integral to that. But you got to be careful. You're not just implementing technology sort of willy-nilly. So we've been very focused on engaging the customer up front, getting them to engage. There's a thought in the industry by some of us that have been around for a while that the borrower should just have to spend 10 minutes on the phone with you filling out a 1003, and then they shouldn't have to do anything else to get a mortgage. And I actually think you're doing the borrower a disservice if you don't engage them in the transaction. There are many people that disagree with me. Many of them are loan officers. They think we should do everything for the borrower and everything should be fine. But if we can't get a VOE, we should waive that because, and just close the loan. And there's a balance between risk management and serving the customer. And I think the answer to it is to engage the customer up front and get them engaged in their process. All right, you go out and log in and get your VOE from me. You go out and log in and get your bank statement from me. You go out and log in and get your transcript from me if we need it from the government. And now you've done everything you need to do. So now the onus is on me to get this thing done, right? Anything, as much as we can push up front to engage the borrower when they're engaged in the beginning with us to get these things done, the better off I think we are. And there's a ton of technology out there to help with that now. And that's what we're focused on. Everybody's throwing around the 24-hour mortgage thing. And we interview pretty regularly. When I talk to people they're doing, I'm like, have you ever done one in 24? No, but I'm about to do one in 72. You know, the idea is just talking about speed brings speed. And I agree, right? So we need borrowers to think that this can be faster, and we need them to understand that we need them to engage in order to do that with the technology that we have out there that allows us to get around the other antiquated technology that costs us a ton of money and doesn't always give us what we need. So that's what we're focused on: speed, 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 and customer engagement. We think that's the key to competing in this market.
Yeah, I think so too. And I mean, we have become a world of we want to self-help until we need help. So it is, you know, let us get as far as we can before we call in the reinforcements. I also think that it goes a long way. You don't need to close a loan in 72 hours. Like contracts are longer that and being in a purchase environment, but at the same time, the faster you can get that borrower, at least a conditional approval and even, you know, a clear to close, let them sit and wait for, you know, several days before they close and the contract comes up, but at least you have them captured. Justin, you're out there listening to lenders. What are you hearing from as their top priorities, and how is Blend positioned itself to support their needs?
Yeah, I mean, everybody's favorite topic is AI, and they're just trying to figure out how to play within that. When you really narrow it down, though, to like what specifically, few things come to mind. I mean, one is we call it shifting left, which is what Kevin just said. It's like, how do you move things further up into the process, which is where Blend naturally sits. So we obviously spend a ton of time on those type things. Honestly,
Yeah.
a lot of the innovation is actually coming in, call it like the pre-underwriting space, right?
Yeah.
Like the online app's been around for a long time. We've had connected experiences, whether connected assets or payrolls for a long time. But so the next phase of like what else can we move left is that pre-underwriting space, which Blend naturally sits in. And can you build some of those into the origination experience, not to give the borrower more to do, but so that we can have a cleaner underwrite and get through quicker.
Yeah.
We're all operators here, so I'm sure you'll all nod heads with this, but you know, an underwriter can only work on what's in front of them. If you are missing information that comes out as a condition for a processor, you know, couple days to get to the processor, a day or two for them to send it out, a day or two for the borrower to get back. It's like, it's a very hard argument to make that like that is better than just trying to collect everything up front when you already have the borrower's attention in a single touch. And so a lot of what we're working, and it's anybody I talk to aligns with that theory. It's hard to implement, right? It's
Yeah.
we have
Yeah.
years and years and years of the traditional way to do a mortgage, but a lot of what we spend our time on is that up front. The AI piece specifically, stare and compare is a lot of what we're doing, where it's just like, what is really practical AI solutions that can actually move the needle quickly for lenders? Stare and compare is like actually perfect for AI to replace.
Yeah.
And that it still sits inside of most lending organizations.
We're running up against time, but before we wrap, I do want to give a moment to clear the air, Justin. There's some creative interpretation floating around in the news. First off, congrats on picking up Citi. That's a huge win for Blend. But one outlet spun it into Blend is focused on big banks, which opens the door for competitors to scoop up small and mid-size IMBs. What's your response to that narrative?
Yeah, no, I appreciate the opportunity. It's don't always get to share my side of the narrative, but that article was speculative, but honestly, the we try to focus on what we can control, and what we are focused on, and me specifically, is serving IMBs of all sizes. The large majority of my day is spent with small to mid-size IMBs, and will continue to do so. And like, if anybody was actually struggling with that and taking that as truth, I'd encourage you to go talk to some of our customers. We have things we're working on just like anybody, but we are extremely dedicated to the space and doing a ton of work to make sure that it improves. And our numbers validate that. I mean, we had almost no churn last year. Account health is at an all-time high. We're adding new logos like across the board. It's all positive. So yeah, I appreciate the opportunity to talk about it. And if somebody has questions, here I am, just
Yeah.
reach out. I'm happy to chat about it.
Yeah, and from being a partner of the Mortgage Collaborative, who focuses on small and mid-sized lenders of all types, we do not see things through that same lens, and we're appreciative of your partnership and your willingness to participate with the makeup of the Mortgage Collaborative. So thank you, and thank Blend for your partnership. So that's a great note to end on. This has been an incredible conversation. Thank you both for your insights and for your leadership. And a huge thank you to Blend for sponsoring today's episode. And to our audience, thank you for tuning in. Your curiosity and feedback and engagement is what fuels us. This is our final episode of November. We'll be back on Tuesday, December the 2nd at 2 p.m. for the TMC members, and live at 4 p.m. on LinkedIn for the broader industry. If you have enjoyed today's discussion, just imagine 3 full days of this energy. Our Desert Disruption Conference is in Scottsdale, coming up February 22nd through the 24th. Early bird registration ends on December 22nd, so get signed up. And if you're not yet a TMC member but want to explore what that would look like, please reach out to me directly. Cheers, everyone, and we'll see you next time on the SIP. Thank you both.
Thank you.